partners all around the world, although implementation has been delayed until August 7th. Dozens of countries are hit here, including Canada. Canadian goods that don't comply with the North American Trade Agreement face a 35% levy. The Prime Minister, Mr. Carney, continues to say that no deal is better than signing a bad one. Let's get the latest from Eddie Ghabour, CEO at Key Advisors Wealth Management. Eddie, thanks very much indeed for joining us. I know it's a moving target. We don't know exactly how all these tariffs will work, but what's your off-the-top reaction here?
So we're looking today as a buying opportunity. I think one of the things we've learned over the last few months are the tariffs tactics are more scare tactics than anything. We don't think 40% or 50% tariffs are going to be anything that's sustainable in the sense of them sticking to it. We still think we're going to be in that 15 to 20% range. And they continue to kick the can down the road. I mean, how many times have we said this is a hard deadline, we're not going to change it, and then they push it back and extend it, 60, 90 days. So we are buyers at the open today. We're going to be putting cash to work because we're looking through the next 6 months. And when you look at the next 6 months, the setup in the U.S. markets looks very, very attractive. We just have to get through this air pocket of August and September. And let's keep in mind, it's weak seasonality as well, too, after a really sizable run. So we just have to navigate what we think will be a 3 to 5% correction at the most here in the next month or two. But buying now will set investors up, in our opinion, for a wonderful fourth quarter and first half of 2026.
Essentially because of strength in the U.S. economy and strong corporate earnings?
Well, the earnings reports and CapEx numbers have been astounding. But when you look at the framework of what the next 6 to 8 months is going to look like, we're going to have a non-recessionary environment. And the Fed is going to be cutting interest rates. Whether it happens in September or December, doesn't matter. In our opinion, the trend is going to be looser monetary policy in a non-recessionary environment. And we're seeing that happen around the globe, central banks loosening monetary policy. And what that essentially does is create a massive amount of liquidity into an economy that arguably doesn't need it. But asset prices always respond very positively to an increasing liquidity environment in a non-recessionary, because usually they have to put these tactics to work when the economy is in a recession. So we're not in one, and they're going to provide the liquidity. That's a Goldilocks scenario for markets.
What about gold, though? Do you feel that there still will be a demand for gold as a safe haven, as an asset that doesn't correlate with stocks, for example?
We do. We are big bulls on gold. As a matter of fact, for our more conservative clients, instead of that have maybe 60-40 models of stocks to bonds, instead of putting 40% into bonds, we think bonds are dead money. We have actually taken half of our position that we would normally allocate to bonds, and we put them into gold because we look at gold as another defensive asset, the same reason why you would buy bonds, for some defensive and less volatility. But we think the upside for gold is going to be tremendous because even in the bullish scenario, there's still going to be a tremendous of uncertainty. You've got a weak dollar. And around the globe, central banks are continuing to want to increase their gold positions. So you have natural demand there. So we think gold has tremendous upside, but a wonderful way to play some defense versus the traditional bonds that, again, we think will be dead money.
What is your favorite way of playing gold? Buying the stocks or buying a bullion ETF, for example?
We're more conservative, so instead of buying the stocks that have a tendency to have a higher volatility, we just buy the ETF that's tied to gold. GLD is one of the ETFs that we have, and that has served our clients really well. We made this big pivot last year, and last year was a great year for gold. And even with the stall out due to the dollar, gold is still outperforming the S&P by a wide margin this year.
You reckon that we're looking at a decade to come in which inflation will be more of a problem?
It is. We have multiple problems here, starting with how irresponsible governments have been with spending and deficits. And so because of this hole that they've put us in, we're going to be structurally in a higher inflationary environment for a long time. And unfortunately, the K-shaped economy is going to continue to get wider. And that means the wealth gap is going to get wider because in an environment of high inflation, it hurts the folks that are living paycheck to paycheck but helps the folks that own stocks and businesses. So that is a concern we have here in the U.S., that the wealth gap is going to continue to get wider and wider, because that could lead to some other issues down the road. But that seems to be the setup that we're going to be seeing here for the foreseeable future.
Would you tend to overweight U.S. stocks right now versus other markets around the world?
I would. China has done well here recently, Europe as well too, but they seem to be potentially topping out. And the U.S. is in the early innings of cutting rates. We haven't even cut rates yet, where the other central banks already have. So the U.S. still has a longer runway, in our opinion, due to how late our Fed is to cutting rates. So we definitely favor the U.S. right now.
What about Canada? When you look at Canada, is our market going to be challenged in the sense that we got this tariff hangover? We don't know exactly how much of our exports will actually be hit with high duties.
You're right, and that's the thing, and right, this is the one thing that we want to continue to stay humble and as bullish as we are, recognize that no one really knows the impact of the trade with Canada until the data actually starts to come in. And right now, the data so far has shown that the tariffs have not had the negative impact that many were fearing. And as long as that continues, we'll stay bullish. But if it changes, we'll have the humility to change with it and sell.
Is there anything that has surprised you with President Trump's tariff campaign? I mean, I know it's been a multifaceted story and it's dragged on for months, but have you been surprised, for example, at how resolute he's been about these things, these duties?
Yeah, at first, I will say this. They are doing what they said they were going to do. I don't think many people believed that they were going to be as aggressive on tariffs. And so that is the one area that I think I'm a little surprised on, is how aggressive the tariff rates were going to be. I did not doubt them that they were going to put tariffs, but I was thinking they would come out at about a 15% rate. And when they came out initially as high as they did and kind of stuck to their guns, I was surprised with that. So, but I think at the end of the day, the markets will speak to tariff policy. It did last time and it will this time. If the bond market does not cooperate, they will step back and cut those tariffs. I have no doubt about that.